This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report. I go through a ton of reading and research every week, and I take the 5 things that I found most valuable every week, put it together into a free Saturday morning email. You can sign up for that at thefelderreport.com. Right there on the homepage, click Join Now, and you'll be good to go. My guest for this episode is Leigh Goehring. You could say that natural resources run in Leigh's blood. The son of 2 oil and gas engineers, Leigh has spent nearly his entire life studying markets and investments related to commodities. Over the past 30 years, he's become one of the most brilliant and passionate analysts and money managers in the industry. In this conversation, Leigh shares the details of his macro and micro research process and how he applies them to investing in natural resource stocks. He also details the case for a coming energy crisis and why energy stocks present investors with a generational opportunity today. So without further ado, please enjoy my conversation with Leigh Goehring.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Leigh, welcome to the show.
Thank you very much, Jesse, for having me.
I'm really excited to have you. This is an interview I've wanted to do for a while. I've been reading your stuff for the last couple of years, and especially with what's going on in the market, I think this is very timely. But to kind of give people an understanding of who Leigh Goehring is, what your background, how did you first become interested in the world of finance?
Okay, it's not only my interest in finance, but it's also a little bit interesting how I became so interested in the world of commodities and natural resources, which is one of my not only what I would say a vocation, but also almost like an avocation for me. I'm really passionate about it and love it and follow it with intense interest. And I should point out that my interest in the commodity space started all the way back when I was a little kid. Both my parents at various points in their career worked for Exxon. And they actually met at Exxon's old Bayway refinery, which is right outside of here in New York City on the New Jersey Turnpike, which of course makes New Jersey so infamous if you drive by it. But they met there during World War II. My father was a chemical engineer there working on with a group that specialized in trying to overcome all the problems of refining and making 100 octane aviation fuel, which is, if you're interested in like something what Daniel Jurgen says, he says that America's ability to make 100 octane aviation fuel is what won the war, since neither Germany nor Japan were ever able to develop a process to make it commercially. But my parents actually met at that refinery. And from a time as a little kid, I remember my father talking extensively about his experience in the oil and gas industry and all the various experiences that he had. And he used to lecture my brother and me too about this is so true. Back in the mid 1960s, he would say, sons, we're burning a lot of hydrocarbons, and at some point, putting all those hydrocarbons in the air could wind up changing our climate. And that's no joke. I mean, he was way ahead of his time. He used to lecture my brother and me about how oil was made, or how it came about to be, and how it was a finite process. And he was also a believer that someday we're going to run out. And I suspect that even though the term Hubbard never came up, I'm sure that he was a follower of Hubbard's research, which was becoming very well known in the early 1960s. We used to talk about other things too. Like, for example, there's a little bit of a hydrogen craze going on right now in the use in fuel cells. And my father always would say, he said, sons, fuel cells will never work because, he said, do you have any understanding of how much energy is required to make hydrogen? Which I think is a very interesting subject into itself. But anyway, I grew up becoming fascinated with the whole oil industry and in the world of natural resources in general. I went to college right at the height of the second energy crisis back, which started in 1977, 78, 79. I did a lot of work when I was in college on the economics of energy and its use in the economy. I disappointed my father. I never became a hardcore engineer like he was. He wanted to become either a chemical or petroleum engineer. I didn't. I majored in economics and math, but my interest goes all the way back to that.
And it sounds like, it's in your blood. And so I was going to ask you, why did you not go into a career, in oil and gas? Why did you choose finance? Was it just, your experience in college and studying the different topics? Was that the kind of what drew you to
Yeah,
the investing side?
yeah. In fact, what it was is that, growing up, my father always told my brother and me, again, you should read a newspaper every day. And I never took that very, very seriously, except when I got to college. I took an Economics 101 course my freshman year, and they gave away a free copy of the Wall Street Journal. And I started to read it intensely, and I discovered that I was incredibly interested about everything that was in there. And I took a couple security finance courses. I became more and more fascinated with it. And I think by the time I was a sophomore in college, I realized that I wanted to get into the finance industry in some capacity. And so I did. I came to work on Wall Street right out of college. I worked in the trust department in an old line Wall Street bank, starting before the bull market started in the early 80s. And I always wanted to somehow combine my interest in finance with running money in the natural resource space. And I finally got my opportunity in the late 1980s. I became the backup portfolio manager of the Prudential Jennison Natural Resource Fund and series of natural resource funds that they had. By 1991, I became the lead portfolio manager. And I sort of now have been doing exactly what I want to do my whole life for the last 30 years.
And that's managing a resource-focused equity portfolio.
Yes, and being able to do what I would call very high-level, intense research on various global commodity markets.
Well, and so let's talk about that. Your investing framework, from my just reading of your work, seems like it's really kind of macro-driven. Is that fair to say?
It's yes and no. We do a huge amount of macro work, but one of the things that we do is we do a huge amount of what I would call very creative and in-depth stock selection in an attempt that when we finally decide that a bull market in commodities is about to take off, based upon our research, we then put together an equity portfolio where we believe that those equities have the best chance of capturing the largest amount of the return in the commodity market, but at the same time, minimize and control the risk that is involved in investing in equities, which there are a lot in the natural resource space.
Yeah, and so I'm just curious to know more about that risk discipline because, as a value investor, we might use things like margin of safety and demand a discount to net asset value or fair value to try and limit risk. A trader might just say, I'm looking to capture the trend, and I don't want to own something that's falling in price. What does your risk kind of discipline look like?
Well, what we do is we're very, very careful to size our various or equity positions according to what we believe the risks are. Obviously, we do a evaluation analysis of every security that we own. So, given a normalized commodity price, every one of our stocks that we own, we do have a net asset value per share, and from that we get a price target. But we adjust it for various things. We adjust it for the amount of debt that's outstanding. What would be the probability of commodity prices stay low for significantly longer than what we thought? What will that do to the impairment of our asset? And we use the size of the position as the way to manage the risk in the portfolio. And I've been through so many cycles in the last 30 years, bull markets and severe bear markets, that obviously we must be doing something right, because even those bear markets, there have been periods when we've had some weak performance, but we've never had anything that would impair the long-term track record of what we're doing.
Gotcha. And so it sounds like it's kind of a stress test, if you will.
Yes, it's a stress test based upon the reward upside versus what we perceive as the risk, which primarily is a function of how much debt that the companies carry. and what that would do to the impairment of that asset.
Right. And I would also just assume that, when you're analyzing the other side of the equation, the reward side, you're looking for those stocks that are going to reward, that are going to have just, I guess, unusual upside relative to average. That's also based on kind of the similar process of that stress testing.
Yes. And what we do is like I said, in each of the various commodity markets where we make investments, we come up with what we believe is a long-term equilibrium price for the commodity, which will oftentimes be a lot different than today's price. And then using that price, we will then come up with the net asset value. And what it will show is usually that the most marginal companies, those with marginal assets, smaller cap, and have lots of debt, also have by far the greatest amount of upside if prices recover. But we don't construct a portfolio with those type of names. We will have those names in our portfolio, but they will be smaller positions.
So it's really a marriage of traditional security analysis paired with your unique macro framework.
That's exactly right. And as far as the macro framework, I should say that we're value investors, and we believe that the best time that value occurs in the natural resource markets or commodity markets, it's when the commodity price is depressed and everyone is convinced that there'll never be a recovery in that commodity price. The companies that are operating in that sector of the market have limited, or sometimes the entire industry will lose a good portion of its profitability. Valuations will be incredibly cheap based upon things like price to book value, certainly not on PEs, because many times the companies won't be making any money. But that is the type of market that we like to get involved in. And that's one of the things that our research does, is that we try to pick turning points in those deep, vicious bear markets.
Well, and that's exactly why I wanted to invite you to come on the show, Leigh, because I think you guys have shared a chart that's been really popular with my audience. I think I've shared it a couple times, either in my weekend email or different things. And it basically shows, I think, the relative valuation of commodities to financial assets. And, on a very long time frame, commodities may have never been as cheap as they are today relative to financial assets.
And that's exactly true. What we've done is we've taken the Goldman Sachs Commodity Index, which has only been around since, I'm going to take a guess, the 1980, maybe it's 1970. And what we've done is we've created the equivalent of it going all the way back to the turn of the last century. And what we've done is we've plotted the returns of financial assets versus the returns of commodities. And what that has shown is that there's only been, in the last 120 years, there's only been 3 times previous to this cycle where commodities have been as cheap as they have relative to the financial assets. And each one of those times was a great time to be an investor in the commodity space.
Well, and that just begs the question. I guess this is probably the most popular question that I get from my audience, which is, okay, I see that commodities are cheap. I want to invest in them. How do I go about investing in commodities?
Well, one of the things is it's very, very difficult to invest in the commodities themselves. And, it's interesting, investing in the oil ETF, which is for most investors is the only way that you can invest in oil. Look what happened just in the last several months back in April, where the ETF, both oil prices and the ETF, went into severe negative territory, which was, I would make the case, we could talk about why oil went to minus $40 a barrel. It was a price that obviously was a one-time phenomenon happening, and oil should never have been there. I mean, the Brent price on the same day, I think, closed at close to $20 a barrel, which was probably where the WTI price should have been as well. So investing in the commodities is always very difficult. And why is that? Well, what people forget is that when you invest in a commodity market, in most commodity markets, you wind up paying to invest in the commodity futures contract. And that premium price that you pay is called the contango. And there's a variety of reasons why the contango exists. It has to do with opportunity costs and storage costs, things like that, which you don't pay when you buy a futures contract, and that makes the futures price higher. Well, that's a cost. And over time, when you have to constantly roll those futures contracts, you wind up basically paying for that contango, which takes a huge amount out of your return. And so investing in commodities directly is a very, very difficult a thing to do. And primarily because of the contango. We like to invest in equities. We think that, we like to say that investing in the equities, you don't have to pay the contango. For all practical purposes, since you're long the commodity, you earn the contango. So when you make an investment in natural resources, over time, we believe you will significantly outperform by investing in the commodity indices themselves.
And in your most recent commentary, you spend a good deal of time on the energy sector in particular. Would you say that's the most attractive opportunity within the resources group right now?
Yeah, and I do. And what I would phrase it is that every once in a while, an asset class gets thrown into what I would call the uninvestable bucket. And it doesn't happen very much. And, an asset class that could qualify, that could thrown into the uninvestable bucket would be an asset class that's been around a long time. It has a huge amount of importance to the economy. And however, because of various issues which are deemed to be permanent but turn out to be transitory, that asset class in investors' minds becomes uninvestable. And I'll give you some great examples of that over the last 50 years. And we can see how it applies to what I would call the great uninvestable asset class today, which is oil. Go all the way back to the late 1970s. What were the two asset classes that were unequivocally considered uninvestable? And most of the listeners probably won't be able to answer that, but they were stocks and bonds. And of course, for those that are interested, the famous thing that came out back then was the August 1979 cover of Business Week magazine, which on the front cover proclaimed literally the death of equities. And why did equities die? And it also applied to the bond market as well, which at the time were called certificates of confiscation. Why were stocks uninvestable and bonds uninvestable? Is because of inflation. Inflation at the time had become an intractable problem that every investor believed that we would never be able to solve. And if inflation kept high and continued to accelerate, the returns on financial assets would always be subpar. And therefore, both stocks and bonds were thrown into the uninvestable asset class. Well, how correct was that? That was probably, Business Week's covers story in 1979 was probably the worst market call ever. The stock market is up almost 35-fold from that point. The 30-year bond, which no one believed you could invest in, has turned out to be an incredible investment. So that's a classic example of an uninvestable class that I just described. Now, this is the other uninvestable class I'm going to describe is much more interesting because it's in the process of becoming a very investable asset class today, and that's gold. If for gold investors, remember, by the late 1990s, gold itself had been thrown in the uninvestable bucket as well. And why was that? Well, there'd been a huge source of new supply that had really come out of nowhere. And that new source of supply was central bank selling. Central banks, which of course had huge amounts of gold in their vaults, going all the way back to when they were all on the gold standard and then the Bretton Woods gold exchange standard, which is in effect up to 1971, finally decided after gold spent years and years going down in price that they had to get rid of it. And all the European central banks, a lot of the global central banks made public announcements, I'm selling my gold. And they started. By 1999, it had gotten so bad that the U.S. Treasury had to call in all the global central banks in a forced meeting where they basically signed the Washington Agreement, which effectively limited their sales to 400 tons a year, which was a huge amount of gold. And everyone believed that the central banks would never stop selling gold. And there were a couple of very famous gold bears back then that said, the central banks will ultimately sell all their gold because it's an asset class that's known is not needed in today's fiat money world. Well, was gold uninvestable at the time? No, absolutely not. In fact, since 1999, 2000, this is hard to believe, even with this huge stock market boom we've had, gold has been by far the best performing asset class since then. You radically outperformed both stock and bond markets by owning it. And it was firmly thrown into the uninvestable bucket. I would say that oil is in that uninvestable bucket today. Why? ESG. The whole ESG movement is trying to restrict the amount of money that's invested in the global oil industry. Demand. Everyone seems to believe that we've reached not a point of peak supply in oil, but we've actually reached a point of peak supply of oil. We've now reached a point of peak demand. That is, demand is peaked right now and will begin to actually decrease for the first time in almost the history of oil. And finally, there's a lot of environmentalists, activists running around that the oil industry should wind up paying for the huge amounts of damage that have been done to the economy in the last 50 years through the burning of hydrocarbons. And whether it be CO2 or other damages, they believe that we should levy these huge fines on the oil and gas industry to pay for these damages. So you have all these factors that are at work that have depressed oil prices to incredibly low levels. And how low? Well, this is hard to believe, but back in 1980, by far the largest sector of the S&P 500 was the energy industry. It topped out at a little bit over 30% of the S&P. 6 of the 10 largest market capitalization stocks in the world were energy related. Where are we today? The energy component of the S&P 500 now stands, I believe, it's at 2.3%. It is the smallest industry group today within the S&P 500. And mighty Exxon, which has now been thrown out of the Dow Jones Industrial Average as well, sports a market cap which is basically equal to today to Zoom. So it's an industry which is incredibly depressed, and I think offers incredible investment opportunity.
Well, I love that you take it back to 1980, and I also love the concept of an uninvestable asset class. There might not be any better buy signal than when the consensus decides something's uninvestable. But I mean, it feels in so many ways like we're at the exact opposite of 1980, where you were talking about it. Inflation then is what made stocks and bonds uninvestable, and disinflation. Is what everybody's just extrapolating out into the future indefinitely. But one of the greatest ironies in the market right now, to me, is that, back then in 1980, you had Paul Volcker, who was dedicated to breaking the back of inflation. Today, we have Jay Powell, who's committed to creating inflation. Essentially, he's made virtually the opposite commitment that Volcker's made. And at the same time, we're seeing, energy stocks are the most hated asset class on the planet. Probably, as Jason Gepford from Sentiment Traders pointed out, maybe the most hated sector of the stock market of all time. It's so ironic to see how things have changed so much in 40 years. That's one of the great things you do in your latest commentary.
Yeah, Jesse, those are all great points. Here's some other things to think about, which I think are very amusing. Again, going back to, I'm a big follower of magazine covers, business publication covers. They often mark huge seminal turning points in markets. And when you figure what happens is that a trend gets going for so long, it becomes so ingrained in investors' psychology that even the wizened old editors of old business publications eventually get convinced that these trends are never going to end. And of course, the most famous one was the 1979 cover of Business Week magazine, The Death of Equities, Why Inflation is Killing the Stock Market. And like you said, it's exactly right, because it was literally only 2 months after that Paul Volcker came to the head of the Fed, raised interest rates aggressively, basically had bonds sport 4 and 5% real yields. These are by far the highest real yields that had ever been produced in the bond market, and they wound up killing inflation and doing it in. And now here's an interesting corner, another bookend, a 40-year bookend to that very famous event, is that back in April of 2019, what's on the cover of Business Week magazine again? Now it's called Business Week Bloomberg magazine, but it's called The Death of Inflation. And on the cover is a picture of a dead dinosaur. And, it's so interesting that after the 1979 cover, it was only 2 months before Volcker put in place a massive disinflation and inflation policy that literally within, less than 12 months, that Powell puts in place what will be perceived, I believe, as a very inflationary policy. And you've been tipped off it's going to happen. The fact that it was on the cover of Business Week magazine in April of 2019 means that it's coming up, it's approaching rapidly.
Well, and as my friend Peter Atwater recently pointed out to me, that The Economist also recently declared, the end of or the death of energy. And they famously did also back in, I think it was 1999 and 2003, they ran a couple of similar covers, right as it was right before the huge boom in oil prices.
Yeah, and don't underestimate the powers. And I read that Economist article, and I should have brought that up. You're right. Classic death of oil story. But, here's another one, back to, how it gives you a great signal that this asset class has become uninvestable. The Economist recently with the oil, that's a great one. But we also forget, like with gold back in 1999 at the bottom. Now, why the Financial Times chose to do this, I don't know. But they actually ran a cover story on the front page of their newspaper. The title was The Death of Gold. And that was December of 1997. And that was the piece of proof that you needed that gold was the buy of a lifetime. And gold, when that came out in December of 1997, gold was $275 an ounce. It traded sideways for a little while, but it was the buy of a lifetime. And you've been given the same sort of buy indicator with that Economist article.
Yeah, and I love how you can compare and contrast Zoom and Exxon. I didn't even realize they have virtually the identical market cap. The only difference is Exxon trades at 0.66 times sales. It's its cheapest valuation in 30 plus years, and Zoom trades literally 100 times sales. It's mind-boggling. I want to dig into the energy thesis a little bit more. Howard Marks has written, he's one of my favorite books is The Most Important Thing, but one of my favorite quotes from the book is, to achieve superior investment results, you have to hold non-consensus views regarding value, and they have to be right. Reading through your Q2 report, it seems to me that you have a strongly non-consensus view regarding the value of energy stocks, and you've made an extensive case as to why you believe you're right. Consensus is clearly demand's going to stay depressed and supplies are easily going to come back online when the economy recovers. Why is consensus wrong?
Yeah, it's very interesting. We'll start with demand, because I believe that is the more popular subject today, that because of electric vehicles, the ESG movement, that we're going to see the world demand for oil actually begin to undertake a sustainable long-term decline. And, we disagree with this. We've done a huge amount of work that looks at at various points of GDP, how much oil input do you need to support that level of GDP? And it turns out that, for example, if in the OECD world, in the developed world, specifically like Japan, United States, Europe, we have reached a point where we're going to see very, very little oil growth going forward. And we haven't seen much in the way of oil growth in the OECD world in the last 25 years. However, what we have seen is a huge amount of oil growth that has taken place in the non-OECD world. And our belief is that growth of oil in the non-OECD world is going to continue. And it's based upon all the research we've done on like I said, the relationship of GDP, per capita GDP, and oil consumption. And what's going to happen in all those countries if per capita GDP growth is going to continue, then oil growth is going to continue at very, very strong rates. And of course, the poster child of this phenomenon is what's happened in China in the last 20 years. And, we wrote a couple really great papers, literally all the way back in 2009 and 2010, that we made projections on what China's oil consumption would wind up being in the following 10 years. The numbers were phenomenal because if you remember back then, there was a lot of people saying that China's oil consumption had topped out. And back then, I believe China's oil consumption was about 7 million barrels a day in 2008. And today, as of today, it's almost hitting 15 million barrels a day. And based upon analysis, it's going to grow by another 10 million barrels a day in the next 10 to 15 years. And it's not only countries like China where the demand, and I should point out, China's oil consumption for the first 8 months of 2020 are now running 1 million barrels per day higher than the same first 8 months of 1999, even with all the COVID pandemic disruptions. There is something still very strong happening in China regarding oil growth. But it's not only China, India. India is, people have given up on India that India is not China, and it's not China. I've been to India so many times, and I understand that statement that it's not China. However, India, we would make the case from a point where India begins to see rapid increases in commodity consumption, including the consumption of oil, that India is where China was in the late 1990s. And, it's interesting. Other than, obviously it's now being distorted by the whole COVID-19 disruption and lockdowns taking place in India. But, India has now slowly crept up to being the second source line item growth of oil in the world today. China's the top. Number 2 is India. Pre-2019, India's oil consumption crept up to be almost 300,000 barrels per day per year. And this is happening whether it be in Vietnam, Philippines, Indonesia, all these countries in Southeast Asia are now all entered that period of rapid intensification of oil consumption. We call it the S curve. They're all entering that rapid point of their S curve acceleration of oil consumption. So we believe that demand is going to be very, very difficult to squeeze oil demand out of the global total consumption in the global economy in the next 10 years. So we think demand is going to continue to defy the bears. But what's really interesting is what's happening on the supply side. One of the interesting things that people probably don't know this, but over the last 10 years, near 100% of global non-OPEC oil supply growth, that is oil supply growth outside of the OPEC world, almost 100% of it has come from the U.S. shales. There's been, in fact, we wrote about this about 10 years ago, saying that non-OPEC, non-U.S. oil supply growth was going to turn negative, which is exactly what it has. In the last 10 years, non-OPEC, non-U.S. oil supply growth has shrunk by about 150,000 barrels per day. So the shales have been the only source of oil supply growth, and we believe that the shales have passed their peak in production and now will begin to decline. And no one believes this, and no one understands what's happening in the shales. And we have done tremendous amount of work in the shales, and we're pretty confident that the great era of shale is over in the U.S.
Well, part of what you refer to in a lot of your research is your neural networks in understanding how these trends are developing. Can you, I guess, tell us what those are and how you use them?
Yeah, what we've done is my partner Adam Rosenzweig is very mathematically and computer savvy, and what we've done is that we have taken a database of every well drilled in the United States over the last 10 years. We go back even further than that. So what we've done is we've captured just about every shale and shale oil and shale gas well drilled. And what we've done is that we put all that data into this neural network. And this neural network, what we told it is that we said, okay, we're going to give you all this data. You teach yourself on how to analyze this and tell us a variety of things on what you learn. And I'll give you a great example of what use we put it to. This is the type of question that it can answer that almost no one can. A number of years ago, there was a common belief that in the oil shales that there was this, because of changes in completion design, completion technology, things like longer laterals, more stage fracks, more proppant being put down hole, all these type of things, is that you were rapidly increasing the productivity of drilling. So what you were doing is you were taking a well, a rig that was drilling a well on a tier 2 prospect. And traditionally, that tier 2 prospect would only produce half as much oil as a tier 1 prospect. But by doing all these changes in completion technologies, you were turning that tier 1 well into a tier 1 well. And everyone believed that. Well, that's an interesting question because it's a very difficult question to try to disaggregate, where the productivity increases are coming from and things like that. And what we did is we said, okay, neural network, tell us where these productivity improvements are coming from. As you teach yourself what makes a great well, and et cetera. And so what the neural network, and remember, these neural networks are all, they are carefully designed to prevent overfitting and things like that. So we don't get spurious correlations and things like that. But what it came back and said, hey, people, the increase in productivity that you're seeing from changing completion technologies is much smaller than what your consensus opinion is. Where all the productivity improvements are coming from is that you are just all you're doing is taking rigs that are drilling tier 2 prospects and you're moving them over onto tier 1 prospects. That's 80% of your increase in productivity. Old-fashioned high grading, what they used to call it in the mining business. And so the thing is that we would use the neural network to try to answer these very, very difficult questions. And we also use it, on an individual, analyzing the properties of individual companies, because it can tell us, it can map for us what are tier 1 properties, what are tier 2 properties, who has the great tier 1 properties, et cetera, things like that. So that's what we use it for.
And that's interesting to me because if it's this process of high grading, that was exacerbated by COVID, then it sets up a clash with the consensus where supplies aren't going to be able to come back online as quickly as most people believe.
Yeah, that's very, very interesting, Jesse. And just one of the things too that we've got this idea that these shale fields are unique in the sense that they almost have an unlimited ability to produce oil. But nothing could be further than the truth. They are very much like a conventional oil or gas reservoir. You start drilling, you begin to increase activity, production ramps up for a number of years, you keep adding more and more rigs, you reach a plateau, and then all of a sudden these fields begin to decline, just like any sort of conventional oil and gas property. And we have two great examples of that in the gas shales where that has already occurred. And they predictably, they are the first two great shale gas fields to be developed. One is the Barnett, which started production in the early 2000s, and the other was the Fayetteville Shale in Arkansas, which was started in 2005 and 2006. Both those fields had very, very steep ramp-ups, peaked, and now are in steep decline. And both fields today are producing only about half as much gas from their peaks. And I should point out that both fields, neither field today has a rig operating on it. There's no drilling taking place. We believe the same thing is going to happen with the oil shales. And what it has to do is that, your drilling productivity begins to decline. Why? As just you mentioned, you run out of tier one prospects. And so you have to drill more and more tier two prospects. Those tier two prospects are not as productive. They require twice as much capital to get the same amount of oil out of the ground. And it just isn't worthwhile. And eventually you just stop. And I should point out that here's an interesting fun fact. Again, the neural network tells us this, is that when did the Barnett and the Fayetteville peaked? They peaked when 60% of their tier one drilling inventory was drilled. And I should point out that you have reached that same point in the Eagle Ford Shale. You've reached that same point in the Bakken. I'm sorry, and you're very, very closely reaching it in both sides of the Permian. So the thing is that the best of the shale days are over.
Well, I love that you compare this to when gold became uninvestable in the late 90s as a result of, I guess, people extrapolating the new gold supply that was coming to market back then. We've seen so much new oil supply come to market since as a part of the shale revolution, that people are just extrapolating this huge supply increase just out indefinitely into the future. And it really does kind of rhyme with that earlier time with gold.
The overlap with gold, the bottoming of the gold market 20 years ago, there's a lot of investors now that, it is an investor generation ago now. Don't remember what it was like, but I vividly remember it because we were very, very bullish on gold back then. And for those that of your listeners that are curious, I was profiled in Forbes magazine, a big profile of me in May of 2000, and gold was still $285 an ounce. And the headline on the profile is "Gold $2,000 an ounce?" ? And we were bullish, and we said that gold was set up to be the best performing asset class of the decade. Now, you're right about supply. It was even I had to really, go through a period of internal fortitude to go through that period, because the amount of new supply was intense, because it was not only central banks that had become aggressive sellers of gold, but the entire gold industry had lost faith in the ability of would the gold price ever recover, and they began aggressive forward selling their gold. And there's an irony here in that all these forward gold transactions that took place starting in 1995 and gathered strength for the next 7 to 8 years, they were all facilitated by bullion banks being able to borrow gold from the central banks. So the central banks, at the same time they were selling, were lending their gold out to producers who were forward selling it. And then what you had is the central banks saying, "I'm selling all my gold. It's not an asset class that I want anymore." All the producers were selling, and then what the hedge funds did, and the bullion banks themselves, they went to the central banks and said, "Oh, by the way, can we borrow some gold from you?" And the central banks said, "Fine, borrow as much as you want. We don't want it anymore." And they front ran both the producers and the central banks. And so there was this torrent of gold supply, but it produced one of the most undervalued markets ever. And that's why gold is still outperforming to this day. And oil is the same way. Everyone is, like you said, Jesse, everyone has extrapolated that the shale is the source of massive supply growth. The shales are impressive. They are. I mean, for example, they've gone from almost zero oil production to basically well over 10 million barrels a day in almost a 10-year period. That's incredible. However, we would say that everyone has extrapolated that going forward, and we believe just the opposite is going to happen. It's going to start to severely decline.
Well, part of this consensus, the bearish consensus towards oil, is related to alternative energy and how alternative energy is going to, I guess, come on quicker than people believe. What are your thoughts towards, I guess, the alternative eating into the demand for fossil fuels?
Well, we've done a huge amount of work on it. We have a very I would call it another very contrarian viewpoint about the amount of impact that electric vehicles will ultimately have on the global oil transportation market. And what it really comes down to, there's this, I think he's Professor Emeritus up at Winnipeg, Vaclav Smil. And, he's written a couple of very interesting books about, the progression of economies and their energy consumption. And it turns out that the advancement of new technologies is basically occur because they improve the energy efficiency of the economy. And I'm going to tie this in with a great example in a second. But one of the problems with EVs is that when you look at all the energy that goes into the production of an EV and the battery, which is incredibly energy intensive, including all the production of all the metals, the production of renewable electricity, which again is much more energy intensive than what you think. That when you add all that together, the energy, the energy in versus energy out of an EV will never match that of an internal combustion engine. Now, I know that is not consensus opinion, because everyone says, "Oh, we'll eventually do it." But here's a good example. Just it was 2 weeks ago that Elon Musk, in his battery day, was going to lay out how they were going to reach in the next several years the ability to produce a car, an EV vehicle, for $25,000, and it came out that there's no way that they can do that, and everyone said, "Oh my God, very, very disappointing." A lot of reasons for that. However, the funny thing is, given an EV or an internal combustion engine, and given the costs that are associated for both, ultimately everyone will buy the internal combustion engine. And because it's too expensive to buy an EV. Now, I'll give you a great example of that. One of the things about Norway is that Norway's, they trumpet the fact that 50% of their total car sales in Norway are EVs today. Now, mind you, they're heavily, heavily subsidized by the government. But what the average Norwegian does is that whenever they have to drive on a toll highway or take a ferry where the tolls on both of them are incredibly steep, they use the EV because EVs get a big rebate on that. You don't pay the tolls if you have an EV. However, when they go up into the mountains to go to their cabins up there on weekends where there's no charging stations, whatever, they take the internal combustion engine. So, it's that, that's a good example of why do they do that? Well, it's cheaper to run the internal combustion engine than it is the EV, especially when you're worried about range anxiety and things like that. Another good example is that, going all the way back to the 1960s, this goes into the whole Vaclav Smil argument, how a new technology, if it's more energy intensive, can't displace the old technology, is the Concorde. The Concorde was developed by the European governments, France and the UK, back in the late 60s. And it was a technological marvel that produced tremendous potential changes in global travel, that you literally cut the time flying in half between U.S. East Coast and Europe. But there was one problem with the Concorde, is that it basically takes almost 2.5 times as much fuel to travel that same distance versus per passenger versus what the competing airline at the time was the Boeing 747. So the Concorde never was able to really gain market share. Why? It was just too expensive to run. And so in the end, now this is interesting because look at the comparison that's developing here. The Concorde became what I would call the plaything of investment bankers, rock stars, and Hollywood celebrities. No one else could really afford to fly it. does that sound a little bit like the people that are buying the Teslas today? It is. And that's the problem. Unless we could reduce significantly the cost to produce batteries, which we're going to need another technological breakthrough, that we'll never get to the same energy economics of what internal combustion engine can combine. So that's not to say it's not going to happen, because the governments can do two things. They can either heavily subsidize the purchase of EVs, which they're doing right now, or they could outlaw the internal combustion engine, which they might wind up doing. So those are the risks right there.
Well, it's interesting. And when I look at the whole case that you're making in terms of supply and demand, and you argue yourself in your latest commentary that the demand supply imbalance that we're facing right now that really nobody appreciates is, I guess, leading us on a path to another energy crisis. Even on par with kind of what we saw during the 70s. I take it then, if that's your thesis, then you don't have the same view of inflation as investors, buying 10-year Treasury notes yielding 60 basis points today.
It's funny. I think what's going to happen, and I like to say that it's going to be a black swan event that causes inflation to return. Now, whether it's a potential problem in our agricultural business, whether we have a series of poor grain harvests on a global basis, or it could be that all of a sudden we wake up one day and say, oh my God, we're short 2 million barrels of oil versus demand, or something like that. But I believe that it's going to be an event like that causes inflation. We have inflation today, except that inflation is just taking place in technology companies. And that something will happen that will cause that inflation to shift into hard assets. And I should point out, Jesse, going back to that chart about how cheap commodity prices are today, and they were back in 1970, and they were in 1999, especially in 1970, is that commodity prices, the setup for what happened in 1970 is almost the exact setup to today. There was a huge amount of financial speculation taking place in the late 1960s, which wound up in the Nifty 50 blow-off in 1972. There was a huge amount of money being printed, and there was the end of a monetary system. When Nixon took the U.S. off the Bretton Woods gold exchange standard in 1971, we've got the same thing today. We have huge amount of money being printed. We have huge speculation taking place in the stock market. We have the FANG stocks instead of the Nifty 50. And we have what's going to be perceived as the coming collapse of the fiat money system. So we are all the way back in 1970 again. And, my gut feel is it will be driven by the emergence of inflation, which will come out of nowhere and maybe be driven by some sort of black swan event that we can't even predict right now, but it's coming.
And so I would assume, that you believe, I think the Wall Street Journal read an article last week about inflation protection and what are the best, ways to protect your portfolio from inflation. Hidden in that article was, energy stocks are usually one of the best ways to do that. They didn't highlight that in the article, I think, because probably energy is so hated they couldn't quite get away with that. But one of the things you point out is that since 2016, oil has nearly kept up, with gold. And yet the oil-related stocks are down 50%, while gold miners and things are up 200% over that time frame. It seems to me that this commodity cycle might already have started working, but oil's giving you an opportunity here to kind of, you look at what oil's done this year. Oil's rebounded strongly, but the energy stocks are on their lows.
Yeah, the energy stocks are down almost 50% for the year. Here's a fun fact, Jesse, regarding what characterizes an uninvestable asset class. Going back to gold, between gold had its final bear market run started in the end of 95 into 96 and bottomed in 2001. From 95 to 2001, the average gold stock during that period declined by 85% in value. The average oil stock, since oil prices peaked in the fourth quarter of 2014, to today are now down 85%. Another good indication that gold has been firmly thrown into the uninvestable asset bucket class, and the bottom is here. Yes, I think gold. I think that oil stocks are incredibly cheap here, and are a very cheap way to give you some inflation projection. They are by far the cheapest way to give you inflation projection. Here's another funny thing. Again, gold and oil. Back when gold was an uninvestable asset class in 99 and 2000, gold priced to oil was incredibly cheap. We've studied this going all the way back to 1858. And when gold is cheap, out of favor, undervalued, 1 ounce of gold only buys 10 barrels of oil. When gold is very popular, expensive, or oil is very depressed, gold will buy 30 barrels of oil. Back in 2000, gold was so depressed relative to oil that an ounce of gold only in the summer of 2000 only bought 7.5 barrels of oil. You had to go all the way back to 1919 to find a similar record low like that, near record low like that. Today, oil is incredibly cheap priced relative to gold, or oil is very, very expensive relative to gold. Right as we speak, last week, again, an ounce of gold bought over 50 barrels of oil, which X the COVID-19 debacle that took place in March and then into April is by far the most expensive that gold has ever been priced relative to oil. Oil is radically cheap. And I think is an incredibly cheap way to give you some inflation protection.
That seems like the perfect way to kind of encapsulate the generational opportunity I think we're seeing in energy right now. I want to totally change gears and ask you something, I guess a little bit more personal. Are there any hobbies or anything, pastimes that you have that inform your view of markets?
Yeah, and I in the last 25 years, my wife and I have we've become huge travelers, and I've traveled all over the world, and I've been to places that very, very few people have ever been to. Like I've been to the infamous mining community up in Norilsk, in right smack in the middle of Siberia, 200 miles above the Arctic Circle. So I've been to a lot of different places, and it's really left an impression on me on the world and how the world has developed and what's happened to the world in the last 20 years. We've seen an incredible period of economic growth, which has benefited we've lifted billions of people out of poverty. And I've been able to watch all that, take place with a front row seat, through my traveling adventures, things like that. So that to me has been one of the most fascinating things about my life over the last 20 years.
Well, and I'm sure it gives you, just a totally different perspective, getting outside of Wall Street, outside of the markets, and just kind of seeing a much more worldly view. Leigh, you've been very generous with your time. I'm really grateful to you. Is there anywhere, my listeners can kind of keep up with you and your ideas?
Yes, we publish, a big quarterly letter, which is out and put into the public domain. All our research going all the way back to where we started the firm in the first quarter of 2016 is on our website. You can access our website, www.gorozen.com. That's GOROZEN.com. You can download it all. It's all free. And you can follow whatever we're saying. It usually, there's a lot of stuff there. And, we speak, both Adam and I speak at a lot of conferences. We do, podcasts and things like that. And a lot of our presentations that we made are on the website as well.
And I highly recommend everybody check it out. I read your stuff religiously, and you're, like I said, not just generous with your time here on the podcast, very generous with the results of all your research in those papers. It's a fantastic resource for people.
Okay. Well, very good, Jesse. Thank you so much for having me on, and I really enjoyed the talk.
Hey, thank you. This has been wonderful. I'm really grateful to you for taking the time. And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.